And just like that, oil prices are right back to that Goldilocks $70 per barrel for WTI. Midwest stocks are still looking fairly tight, even though Canadian imports really bounced back this week. But you know what? This might be a great year for that family road trip. We'll talk about that here more in a minute. Hey, I'm Aaron of the Oil Balance with 30 years of experience in oil trading and analytics, and I'm here to elevate your understanding of the oil markets. But as usual, let's get into all the crazy headlines that we saw this week. All right, here we go. Definitely seeing still some uncertainty on the tariffs. Trump keeps talking about maybe walking them back, maybe some negotiations still going on. It seems like on the at least on the crude oil front, things seem to be going smoothly in terms of not a whole lot of new news on that front, and that's kind of good for the market to be able to sort of recalibrate for a little bit and get back to sort of an equilibrium and figure out. It's hard to make plans when everything keeps changing, right? So I think it's good that we haven't had a whole lot of news, at least on the crude oil front of tariffs, but we did get big news on the automotive front with Trump saying he wants to put 25% tariffs on automobiles that are imported into the USA. If they're made here, there's no tariff. If they're imported, he would give us a tariff or he would put a tariff on them. So again, I think if these continue, if this stays in place, longer term, I think that's actually pretty bullish on diesel fuel. You're going to be building more plants or utilizing more plants. As you're making more vehicles, you need to get them from the sites that they're made to the places where they're sold. So yeah, I think overall it could be fairly good for diesel demand, probably in this year as you're still sort of building out infrastructure to help overcome those tariffs and get more stuff made here in the US. On the Ukraine front, it's still, there's still a lot of fighting going on. It still seems like both sides are trying to entrench and to keep the territories that they really want to keep when we get up to, hopefully, when we get up to a some sort of peace deal in this war. It seems like for now, both sides are fairly agreed that they're not going to take out energy stations, either in the Ukraine or in Russia. We'll see how well that works. Um, it seems like both sides are at least trying to get to some sort of resolution to this. So we'll see what goes on there. But in a couple related news, it's sort of more pertinent to the oil markets. The ESPO diffs sink as Chinese buyers sort of shy away. So ESPO is a Russian grade, mainly it comes from the eastern part of Russia and usually stays in the Far East. Going to refiners in the Far East to be refined. So those diffs are sinking as the Chinese buyers kind of start to pull away a little bit, because of all the sanctions going on. And it does seem like they're taking more VINs. At the same time, we're seeing some of the diffs for the more commercially traded or futures traded like Murban and Dubai. Those diffs are actually blowing out. The spreads are blowing out as China backs off of buying some of these Russian grades, and the market now has to equilibrate and find some other crude that they can get into their system. And then India denied entry to a vessel this week that was carrying Russian crude oil. The vessel's pretty old, and they decided that it was, getting too old for them to bring in. They didn't have all their paperwork in order. But I think really what it comes back to is the Indians maybe shying away also from a little bit of Russian crude. The point is, if we do come to some sort of, stand down or resolution or peace in the Ukraine, we would get a reversal of a lot of these sanctions that the market has put on Russia, primarily from the U.S., but also potentially from Europe too. Obviously, a little bit of different feelings between the different political parties in the US and in the EU at this point in time with regards to Ukraine. But if we do get a pullback on some of these sanctions on Russian barrels, that does sort of ease the whole global system a little bit, making it just smoother and easier to trade, which I think probably should take some risk premium out of the market, and I don't think there's a lot of risk premium in there now, but it probably should reduce that a little bit. On the other hand, Iranian tensions are still ramping up. Iran did respond to Trump's letter from last week. I haven't seen what that letter says. It sounds like they want to negotiate, but they want to, negotiate on equal levels as we've seen before. So the US military is definitely building up in the area. You've probably seen other YouTube videos about that. If not, it's pretty easy to find. And the US still continues to go after the Houthis in Yemen. So again, there's the potential, for things to sort of break out into a wider war. There's the potential for some military action to actually happen in Iran. So we'll see how this goes. Again, this says to me we should be adding more risk premium. So maybe we're taking a little bit off for Ukraine, but maybe putting some back on for Iran. Iran does, as I think we discussed before, Iran exports around 1 million barrels per day of light crude. Could that be replaced by U.S. crude? Maybe that's what the Trump administration's thinking. But we'll see how this continues to play out. But definitely something that we need to really keep an eye on. And then the last thing I want to bring to your attention this week in the headlines is the Asian market seems to get a little bit lackluster. As we discussed a second ago, the crude diffs in the region are getting stronger. And I think that's because you're seeing buyers back out of Russian oil and they're having to go onto the futures markets or the big cash markets in the region and sort of bid those up to keep the barrels coming to China. There's talk about the Saudi OSPs getting cut, so the official selling price into the Asian countries. Some grades, their expectations for that to get cut by at least half. As it's a premium over an index is the way they're priced into Asia. And then today we got the second batch of Chinese export quotas for gasoline, jet, and diesel. Now this is coming out pretty early. We're recording this at the end of March. Last year, they did the second batch of export quotas in May. So, doing it much sooner. The actual volumetric quotas are down year on year, but they're doing it sooner. So that's kind of sending a little bit of a mixed message. And then on the fuel oil / bunker side, those export quotas actually went up 1.2 million tons year on year. So the reason these are significant is the entire market is expecting demand growth to come out of Asia, especially the emerging markets, especially China. If there is something going on in China where they can't, or I should say maybe in Asia in general, where they can't reach these demand forecasts, then the market's going to be looking pretty heavy because it seems like we are getting the production side of the market. The supply side of the market is stepping up, hoping to fulfill what the demand forecasts are, right? If that makes sense. So we need to be keeping a close eye on Asian demand as usual. That's sort of nothing new. That's the way the market's been working the last several years. But now we're getting some hints that, maybe things are a little bit softer in China. To be fair, the demand in refined product is usually coming from the light ends. So things that you would use to make plastics and not necessarily gasoline, jet, and diesel. But as the Asian economies sort of develop and grow and they're making more things out of plastic or whatever, you sort of would expect that gasoline and diesel demand to increase as they produce more things and have to get that out to market. So going back to our first set of headlines, of course, you've got the tariffs, which just add a whole different level of uncertainty on top of all these different things. So again, it all sort of works together. And sometimes it's a bit of a feedback loop, but we definitely need to be keeping an eye on what goes on with demand in Asia. Okay, so as I mentioned, the Midwest is getting pretty interesting. Cushing stocks now are down to 22.7 million barrels. That's down about 3 million barrels from this peak a couple weeks ago. Sort of doing anti-seasonal move. As you can see, like on the 5-year average, we typically increase in the springtime. Last year was a little had some big moves, kind of flat for a while and then moved up and then slowly ground lower into the summertime. So it's a bit unusual, the pattern that we're seeing right now. but it is what it is. We're below the 5-year range. So that's just for Cushing itself. For the rest of Pad 2, so just taking Pad 2 stocks and subtracting Cushing inventories from them, it's looking a little bit more stable, kind of in the middle of the range. I would say, however, this 5-year range is a little bit deceptive. So if you took 2022 out of the 5-year range for whatever reason, inventories would be at the lowest. So in other words, in 2022, we we're down here around 77 million barrels of inventory for this week. And the other years of the 5-year range, we were all much higher than we are right now. So 2022 really skewed that 5-year average or 5-year range lower in this instance. So again, Midwest is looking fairly tight, at least on the crude oil side. Crude oil runs, so inputs to refineries keep grinding lower, but we are on sort of the higher end of the 5-year range. By the time we get into midsummer, we should expect some pretty strong runs between now and then. But that, again, you get in product demand also ramping up at that point in time. So it makes sense to be sort of at max runs. And then Canadian crude imports this week really bounced back. Again, this is total Canadian crude imports from the weekly numbers, which is just sort of a preliminary number. It's not really set in stone. And these would be imports going to Pad 5, Pad 4, and Pad 2. So that'd be West Coast, Rocky Mountain regions, and the Midwest. So they did bounce back. If you look at the 3 weeks we've got data for so far in March, we're still 273,000 barrels per day below the February average. So this last week's number really skewed the averages up a lot. So we'll see what happens next week to get a full March number. Maybe we'll get an even higher import number. We'll see, but things aren't looking quite as dramatic as they were last week, at least on the front of the Canadian imports. Switching over to gasoline season, real quick, inventories still remain high nationwide. That is, Pad 5 stocks are relatively low. West Coast stocks are still relatively low. So inventories sort of east of the Rockies are still looking pretty decent. In Pad 2 that we just spoke about, we're still barely above the 5-year range. And we are sort of getting a seasonal type drawdown now that you would expect this time of year, but we're just starting at a much higher point, coming much later in the year. So again, there shouldn't be anything super bullish about that just yet. We'll see how the rest of the summer goes as we get into proper driving season in April and see if we can get some bigger draws in there that would maybe push gasoline back into a more supportive situation than it is right now. Across Pad 1, so this is East Coast inventories. Again, they still remain fairly high, but maybe even more significantly in the NYMEX delivery zone. So if you go through the futures delivery process on RBOB gasoline futures, inventories are actually looking pretty high right now, whereas last year they really fell. They were starting to fall already this time last year. And then Pad 3, we've kind of made the transition already from winter spec going more into summer spec. There's a couple steps before we get into midsummer spec, but we are starting to price out the A2 M2 gasolines now, and inventories are bouncing back. We sort of seems like what usually happens is we purge ourselves of the higher RVP product and then start to ramp up on the summer production, getting ready for that summertime demand. Yields are still looking fairly low, but again, sort of following along with what we did last year, we would expect them to sort of rotate higher just naturally again as demand sort of increases as we get through the summer. You probably should see yields increase a little bit and maybe a little bit better than a year ago. But again, we're not in a dire situation in terms of inventory. So that might be a little more difficult to pull off. The reason I say that is if we look at gasoline futures minus diesel futures, with the this dark orange line here being from the 17th of March, and then 10 days later, the blue line is from the 27th. You can see that gasoline futures are at a premium, or at least 10 days ago or so. They were at a premium through most of the summertime to diesel fuel. Now, 10 days later, sort of yesterday's settlements as we're recording this video, you've only got 1 month really where it stands out that gasoline is at a premium, and then it kind of goes back to a discount after that. So as I might have mentioned before, it's going to be you're not going to get a huge yield switch coming from the refiners unless you get a clear price signal to do so, and we're definitely not doing that. So yes, you're going to get a ramp up in yields just because seasonally there's more demand and the refiners have contracts to supply barrels and they're going to fulfill those contracts. But we're not set up, at least at this point, we're not set up to see any incremental changes in yield going towards gasoline because of price signals. We're just not getting those price signals. If anything, you can see on the diesel front, prices are have been kind of grinding lower. Gasoline prices on the retail front actually ticked up a little bit this week, and as I sort of cautioned before, that should be expected this time of year. As we move into the summer spec, we should get a little bit of increase in price just because it's a more difficult product to make. However, we are hovering I shouldn't say pretty far below, but we are below year ago levels. So definitely that impact at the pump in your wallet when you fill up your car is less than it was last year, at least on a US national average for retail gasoline. And same thing for diesel fuel. So this is actually a good sign going into planting season for our farmers. It should be a little cheaper than it was last year going into planting season. So finally on crude oil futures, I like to look at the weekly chart. I think it kind of stepping back, it gives you a little bit more of an overview. So 3 weeks in a row now, you see these green up bars on the candlesticks, and we did hit above 70 earlier in the week, but we've come back down to the sort of the low 60s at this point. But making a pretty good bounce back off of what was a really nice sell-off so far in the year 2025. So what I've done here is I've highlighted a Fibonacci retracement. So these tools can sort of help us to see where the market might bounce back to. And what this is indicating, going off of the tippy top of the high up here, around the time all the sanctions were first announced and that sort of thing, versus the low that we've got here a couple weeks ago, that would suggest bouncing back into sort of this $75 range or so, which kind of coincides with this uh, resistance line that we've drawn in here, sort of this long-term sloping resistance line. So again, it's not going to happen overnight. Well, at least not without something literally blowing up in the Middle East. But I think we do have a shot at sort of grinding higher to get up to that level, which again, it's kind of like $65 is sort of maybe the low end of the range where you start to get nervous about production and that sort of thing. $75, again, probably shouldn't hurt the consumer too bad. Not as, especially because gasoline inventories are so much higher than they were this time last year. It probably should be okay to get crude prices to just come up a little bit and maybe put, if they had to, and just put a little bit of pressure on the margins without completely collapsing them or anything like that. So that's what we're seeing this week in oil. If you like this, please comment and please like the video, and please remember to subscribe. If you have ideas for future videos or things you want to talk about, things you want us to discuss, please put that in the comments below. I've gotten a friend of mine sent me some really good suggestions here just the other day for future videos, and we'll definitely be going into those in more detail here in the near future. But thanks for tuning in, and we'll see you next week.